Hi everyone, a very good evening to our audience today. So excited to see that we actually have such a great turnout. And I'm Justin and I'll be your host for tonight's episode of our Ask Me Anything webinar series. So tonight we are going to find out more on are REITs still a smart investment now? So REITs or real estate investment trusts have been a long favorite among income-seeking investors, offering exposure to the property market without the need to buy physical real estate. But with rising interest rates, market volatility, and shifting economic conditions, I'm sure many of you are beginning to question if REITs still hold the same appeal today. And this evening, we will dive deeper into how REITs are performing in the current environment and what factors should investors like us here should pay attention to, and whether there are still opportunities to tap on in this sector. So let's dive in and explore. I'm sure everyone here has some burning questions. So before we get started, may I request that you can type your questions into the bottom Q&A. You can see the Q&A box below. Do type in your questions, and the speakers will actually come to it at the end of the webinar where we have our Q&A segment. So they will answer your burning questions later. For the audience, we are also live on Zoom and Facebook. And before I introduce my guest tonight, I want to assure everyone here that there will be no selling during tonight's webinar. Tonight we want to keep it completely educational. So let's keep this session lighthearted, sit back, relax, enjoy your evening here while the speakers share some of their thoughts and views with us. And if you are watching us, please share with your friends as well, whom you think would benefit from this webinar fireside chat, where you can ask all your questions that you have about whether REITs are still a smart investment now. You can ask them live to our very own financial specialist here tonight. Okay. So who are they, right? Very thrilled to introduce our three panelists for the night. They have different life and industry experiences and perspectives. So tonight we have, firstly, we have Darren Chew, Senior Financial Services Director with Phillip Capital with us. Bryan Tan, Senior Financial Services Manager. And also we have a guest speaker. We have Charles Lee, Senior Fund Manager of Public Markets from Phillip Capital Management. So each of them will provide their unique viewpoints and their experience for tonight's topic. So let's look forward to that. Yeah. Okay, so our very first speaker of the night, so Darren, Senior Financial Services Director with Phillip Capital. So Darren is actually both a certified financial planner, CFP, and a chartered financial consultant. And he has 2 decades of experience in comprehensive financial and investment planning. He's also a passionate advocate for financial literacy because he's an IBF accredited trainer. So he's also currently conducting courses on REITs analysis. And the funny thing is that I actually met Darren when he first started out as an IBF accredited trainer. So I've actually seen firsthand his passion for sharing knowledge and how he likes empowering others through financial education. So yes, Darren, please say hi to our audience.
Thank you, Justin. Hi, everybody. I'm Darren Chew here. Actually, with over 20 years of experience in this financial industry, I have met actually more than thousands of clients, and I observe firsthand at how financial literacy remain a major gap among the public. So I strongly believe that everyone deserves access to both practical and affordable and high quality financial educations. And I see many people struggle with those financial decisions simply because they have never been properly guided. So my goal actually is to bridge that gap by providing those real-world actionable financial insights that empower individuals to take charge of their financial future. As what Justin I mentioned, I'm also an IBF accredited trainer under the Institute of Banking and Finance, where I actually conduct financial courses for both professional and the public. And back to you, Justin.
Thank you, Darren. I'm sure that we will have a lot to learn from you tonight. Yeah. Okay. So next, our second speaker, we have Senior Financial Services Manager, and he's also an SGX REITs ambassador. We have Bryan here. Bryan has consistently demonstrated his excellence in wealth management and client advisory. He also helped clients grow and protect their wealth through strategies spanning equities, REITs, bonds, retirement, and estate planning. So we got him because he's an SGX REITs ambassador. He actively promotes REIT education and help investors better understand this asset class. So, hi Brian, would you like to share more about yourself with our audience?
Yes, thank you, Justin, and good evening, everyone. Throughout my career, I have been a strong advocate on income generating investment for building wealth. This is important to focus on reliable and sustainable income with steady gain rather than chasing short-term or speculative trades. So over the years, I've developed good knowledge and experience in wholesale bonds, income-focused funds, dividend-paying equities, and more importantly, REITs, which is our today's topic. So by diversifying across various asset class, it helps to achieve more consistent return while reducing your investment volatility and in different environment. Personally, I do believe success in investing is not just about focusing on return. It's probably far more important to manage the emotional aspect of the investment journey. So without emotional discipline and self-awareness, it will be a challenge to scale up the size of your investment portfolio. So do take note, it is never good when investment become too excited because when emotion run high, decision tend to suffer. Yeah.
Awesome. Thanks, Brian, for the introduction. What we are excited here is to be able to learn more from you tonight, lah. Yeah. Okay, let's move on to our next speaker. So, okay, last but not least, we have a special guest speaker for the evening from Phillip Capital Management. So Phillip Capital Management is actually the asset management arm of Phillip Capital Group. So here we have Charles, Senior Fund Manager of Public Markets, joining us tonight. So Charles has been with Phillip Capital since 2007, bringing with him extensive experience in securities dealing and portfolio management. So I think it's exciting to have him here with us tonight to share valuable tips with for our topic. So Charles, would you like to introduce yourself to our audience tonight?
Hi everyone. Thanks for having me here this evening. With more than 2 decades of investment experience, I would say we as fund managers tend to be more sensitive towards what is happening around us than most of the people on the streets. But of course, that to say that we are not FOMO when it comes to making decisions to buy or sell. My understanding on the difference between the professional manager and the novice investor is that we verify on the information and the data we pick up from our sources and make the call when it's deemed right to support our investment thesis. So, yeah, thank you.
Thank you, Charles, for the introduction. Yeah, I think Charles will be going more, share more about being the role of a fund manager later tonight, lah. So we are looking forward to it. Yes. Okay. So now, before we go to the first question of the night, right, let's find out a little bit more about our audience today. We will do a little poll. So I'll read and flash the poll right now. So if you're on Facebook, you can comment in chat box your answer, and if you're on Zoom, you just have to simply click your answer. And we shall wait 1 to 2 minutes for the result to come in. So poll number 1 is, how familiar are you with REITs? And options will be 1, I currently invest in REITs. Number 2, you have some basic knowledge. And number 3, I've never invested in them before. So yeah, let's see what our audience put in. We'll give you a while. Okay, so we see the highest percentage would be that we currently invest in REITs. Yeah. And then second would be some basic knowledge and a small amount that say never invested in them before. So I think we have content for everyone here tonight. Those who you currently invest, maybe you have some doubts, some questions, we will be happy to share them later. And for some basic knowledge, maybe you want to find out more. And those who never invested before, our speakers are going to share with you what you need to look out for and what's the market right now before you decide to invest in REITs. Yes. Okay, so now we will move on to the first question of the night. So, first question of the night, what exactly are REITs and why have they been such a popular investment in Singapore? So, Darren, would you like to share with us first?
Okay. Actually, REITs are investment that let you earn income from big properties like shopping mall and office without actually physically going and buy those property. So, and they are very popular in Singapore because they pay higher dividend than many other asset class and are very easy to buy and sell like regular stocks. And that's back to you, Justin.
Sorry. Yeah. Okay. Thank you, Darren. How about Brian? Do you have anything to share?
Simple understanding, REITs is similar and comparable to landlord business. So we invest in REITs for the dividends, as if like a rental income. And at times we will sell the REITs for profit when the price went up well, as if like selling the property for profits. So there are many good reasons why REITs are popular investment in Singapore. One of them will be REITs do generally offer higher dividend yield, compared to other income generating assets like fixed income and other dividend counter. So example, like corporate bonds will be probably in today's market less than 3%, and government bonds now give a 1 point something kind of percent. And also that's why it's assets to be considered. Second, especially so today in today's low interest rate environment for Sing dollar, where FD now is around 1%. So it makes REITs investment even more appealing. So when the risk premium on the REITs dividend is more than 3%, and which is quite higher, and that gain market interest and attentions. So on other popular reason, I shall leave it to Charles to cover more in depth.
Thank you, Brian. If you notice that the Singapore REIT has more than coming slightly more than 2 decades of history, those people have started investing in the first IPO REITs, CMT, back in 2001 itself. Many investors are very familiar with them over the years because it's very close to our heart. For example, you look at Bishan Junction, the Ang Mo Kio Hub, and Mount Elizabeth Hospital's Fai's Rendezvous Hotel, especially during the COVID days. Staycation was so popular among the Singaporeans where government has actually promoted it. And not to mention Suntec City itself. And these are assets and some of the listed REITs in Singapore where most of us will shop, eat, and work, and also seek medical treatments in all this location itself. REITs, like what my previous two speakers has mentioned, they pay out a regular stream of dividends, and this either on a quarterly or half-yearly basis itself. This is very, very favored by Singapore investors, especially the the elder generation investors itself. As you know, we are a aging population itself. A lot of our Singaporeans actually when they invest in equities itself, they will want to seek a higher dividend streaming equities itself. So REITs actually play a very, very good fit in terms of this investment asset class itself. REITs fits well in any asset allocation model between the fixed income and equities. It features both the asset class mentioned, and its cash flow could serve a good buffer during market downturn. Yeah, so I mean, we have gone through the cycles. Cash is king. That's what everyone would notice it. Thank you.
All right, thank you, speakers, for breaking that down. So to sum up, I think REITs allow investors to earn income from large properties without owning them directly. Our speakers mentioned, offer the potential for capital gains, and they are also especially appealing in today's low interest environment. And with a long track record in Singapore, regular dividend payouts, and a role in balanced portfolios, it's clear why REITs actually remain a popular choice for many investors. Yeah, thank you. Let's move on. So for our next question, what are the key risks and opportunities of investing in REITs? So what should investors look out for? Very important question tonight. Darren, you want to go first?
Oh, okay, thank you, Justin. Okay, the key opportunity is what we have all mentioned, that let you earn regular income by just like owning property, and without need to buy the property by itself. And your income also can increase when the REITs increase their rental, and also that when they buy a new well-managed property and add into the REITs portfolio, and your dividend will, in short, income will also increase. But however, do take note that if the interest rate were to rise, which what have happened previously in the past few years, the REITs price will often fall because of the borrowing costs have go up. And thus, at the point in time, investor may want to run to bonds, which what happened. But now interest rates have come down, and this is why REITs now become more attractive, especially when you see all those bond interest rates have actually dropped quite a fair bit. But another key risk for REITs is vacancy. If there's tenant leave or the rent drop, then the REITs income will go down, which we have seen it happen in some of the REITs currently. And lastly, which I feel that is the most important one, is the capital management side. If there is due to poor capital management, like for example, the risk manager may take too much debt or their interest cover ratio is too low, and that will actually hurt the risk performance. So thus it's very important to choose your risks carefully for that. Okay. Maybe Ryan, you want to add some more? Brian, you want to add some more on that?
Oh yeah, thank you, Darren. I will just cover on the key risks that investors need to consider. It's important to understand that all investment, including REITs, will have some level of risk. And I will just probably narrow down to the three main risks that you all should be aware. First, market risk. Second, management risk. And third, interest rate risk. So on market risk, REITs are equities listed in an exchange. So the price movement will be volatile from time to time. Now, similarly tied to other shares. So you'll be easily influenced by a macro environment and market sentiment. Okay, and two will be the management risk, as mentioned by Darren. Okay, after all, risk is a business. So the micro performance has to be strong. It has to be well managed, making all the good decisions to maximize the potential of the properties. So one example will be Savannah REITs. Due to their continuous poor management, the share was somehow underperformed and DPU just keep dropping. So the investors got so frustrated and they just fired their manager 2 years ago. Yeah, and third will be the interest rate risk. I think probably this is the one of the key thing you'll be trying to understand more. Right? So REITs typically rely on debt to finance their property. So market interest rate impact their borrowing costs. That leads to dividend performance. Typically, a high interest rate environment will be favorable to the REITs as their borrowing costs went up. Okay, sorry, will not be favorable, sorry. And especially so when they refinance their loan, it will be a higher rate, leading to higher costs. By today's lowering interest rate environment, it has somehow turned favorable and a catalyst for REITs investment. Charles, what's your view on this?
I share quite similar views with Darren and Brian itself. I think Darren also has mentioned initially mentioned about capital. Brian also has mentioned about interest rate risk itself. These are two components, very important components when we look at when investing in REITs itself, because all these are, especially interest rate, it goes in cycles itself. I mean, back in 2022, interest rate was actually spiking up because of the Fed fund rates also has risen itself. The Singapore SORA, which is the Singapore overnight rate average, was also spiking for almost like more than a year until it is stabilized. Until recently, towards the end of last year, it came down. Currently, it's doing about 1.3%, which is quite comfortably for everyone who is investing in properties, especially REITs owners as well. That's why you can see this year and towards I mean last year itself, a lot of acquisitions is actually coming in by the sponsor, the landlords itself, names like Capital Land, Capital DCs, I mean acquiring Tokyo Data Center 3, CICT also acquiring the Capital Spring Grade A Tower, and a couple of more names that you can see or you read in the news itself. Interest rate is a very, very sensitive, thing to look at. I mean, if you back in the 2022 period itself, the interest rate was spiking high itself. It's very difficult for the landlords, I mean the REITs owner itself actually to do refinancing. So a lot of them actually hold back the refinancing unless I mean, of course, they are also subject to the yearly refinancing profiles that they are looking. I mean, they have to go through itself. With this kind of low interest rate environments, I'll say, and moving forward, REITs are better off than the past few years, and it will be even better because lower interest expense itself will increase the DPU DPU is actually the distributable income that's being distributed to unit holders like most of the investors itself. Of course, another thing that we look at is actually the 10 years treasury yield, which is a Singapore 10 years treasury yield itself, which is also doing about 1.85% as of now. And the yield spread between the 10 years and the yield of the REITs itself actually gave us indications as to when is a good time to invest in REITs, especially when the yield spread between the REITs yield versus the 10 years yield itself widens. Investors tends to be more comfortable. It's better off investing in REITs. That's why you can see on the average itself, I think now it's about doing about 3% for the past 3 to 4 years. But on the 10 years average itself, I think the yield spread is actually doing about 3.7%. So currently the yield spread between the REITs yield and the 10 years is actually doing about 3.6. So slightly below the average, but still comfortable because I think Singapore has been a sought after Sing dollar asset classes. If you look at the fixed income side, the fixed income yield also has been depressed from the treasury all the way to the investment grades fixed incomes. If you look throughout the past year to date, because of the dollarizations going on in the capital markets itself, Singapore with its AAA ratings, the currency is actually very sought after. They go for the fixed income side. After the demand for the fixed income yield actually assets has been very high, pressing down the yield, and then the next one they'll go for the high dividend yielding assets like REITs. Yeah. Thank you.
Okay. Thank you. Thanks, speakers, for walking us through both the opportunities and the risks of investing in REITs. So I think to sum it up in plain terms, REITs can give you a steady income and the chance for growth, but they are not without risk. So there are market swings, management decisions, as our speakers mentioned, and interest rates also can all impact your returns. And the key takeaway here, I think, for us investors would be to do your homework, to pick wisely, and also to understand what you're investing in. That's most important. So with that in mind, let's move on to our next our second poll of the night. So same thing, we will flash and read out the poll right now. Okay, so when you think about REITs, what appeals to you the most? We have 1, regular passive income, 2, potential for capital appreciation, 3, diversification of portfolio, and 4, stability compared to other investments. So same thing, if you're on Facebook, you can comment in your chat box, and if you're on Zoom, just simply click your answer. Yeah, let's see what the audience think. Okay, I think it's quite clear. So the one that people choose the most that appeals to them will be what I would choose also, regular passive income. So yeah, we have that, then followed by diversification. We hear this word a lot. I think you will hear it a lot throughout the night also as well. Yeah, and followed by the rest. So okay, let's move on to our next question. So this actually, the poll just now, right, on what do you think appeals to you the most, it actually leads us perfectly to our next question. So are REITs better suited for short-term gains or long-term building? Let's get Darren to start sharing for this question first.
Okay, thank you, Justin. Actually, REITs are generally better for long-term wealth building. Although I'm a reminder myself, but I tell my client that don't do short-term trade on REITs, because REITs, the objective of getting REITs is to get steady dividends, and then you're able to give you a consistent income over time. And their value will grow gradually as their rent and property value will appreciate over time. We got a classic example like Parkway Life REITs, where you can see their rental income and property value appreciate over the more than decades. So, but in short term, REITs price can actually swing quite a bit due to market sentiment or interest rate change. So, but for long-term investor who want regular income and potential capital growth, REITs actually should be part of your diversified portfolios. And maybe I'll pass to Ryan to share his view on that.
Oh, thank you, Darren. I would say both. Because according to the SGX data, the volume for S-REITs is actually more than 200 million units change hand daily this year. So what this means is there are so many REITs trading activity happening daily in Singapore Stock Exchange. There are lots of traders and participants making the short-term gain and speculative trades in the REITs market. After all, it is a highly liquid asset, especially so for most of the large cap REITs. But for the viewers today, do think long term and invest the same. It probably works better for you. Yeah, how about Charles? What's your takes on this?
I'm more skewed towards the long-term wealth building idea for REITs itself. Because personally, I mean, during our course of our job, we are more on the asset allocations approach when it comes to our investment itself. So I believe any investors who believe in long-term investing, asset allocation should be a core practice in the investment approach. So investing in REITs actually will fit well between the fixed income and the equities, given its high dividend yielding nature. Also relatively positive correlations of assets appreciation with inflation itself. So inflation, some investors will say inflation is no good, but for assets, acquiring of assets itself, inflation over the long term is actually good for REITs itself. But of course, it's a very sensitive things. When inflation's is high itself, I think the REITs also will rise accordingly, and that is also very negative for REITs in terms of the refinancing. So REITs actually is very stable, and in terms of the momentums, I won't say the prices will jump, just like tech stocks, or even like your Bitcoin itself. So the approach for REITs is, to my understanding, has always been the collection of dividend yield. Of course, the collection of dividends payout is actually also very have to be very careful, because sometimes a high yielding REITs might not be a safe thing to. I mean, you have to pay attention to what is undergoing in the REITs itself. If you look back prior to the COVID itself, those US office REITs actually was doing very well. A lot of, I think, retail investors also has got caught into all these US office REITs, and post COVID, all these US office REITs actually has collapsed very badly, because of the occupancy rate actually has dropped tremendously as compared to Singapore office REITs itself. That's why you can see the great difference between the prices in the US office REITs versus the Singapore side. Things that when you look at office REITs itself, you have to look at the occupancy. But of course, a lot of times it's actually the policies, and then the getting the feel on the ground works itself. So in US itself, I think we are not in, most of us are staying in Singapore, so it's very difficult for us to get a feel of the US, unless you have very you read deeply into the reports itself. Yeah. But also the cash flow from the yield could also serve as a buffer in terms of the downside of the market. So this is also very good for long-term wealth building, and also provides when you have a good cash flow from your investment itself, it provides a very good form of discipline to make cash available, especially when market are toppish itself. Yeah. Thank you.
Okay. Thank you, speakers, for sharing these insightful points for consideration. So I think the takeaway here is that REITs are generally more suited for long-term wealth building. They offer steady income and gradual growth over time. So while the short-term price swings can happen for all the investors here looking to build a diversified portfolio with consistent returns, I think we can say that REITs can be a strong option for you, definitely. Okay, next, we'll move on to our next question. So for our next question, which sectors or geographies should investors be paying more attention to right now? Brian, would you like to go first?
Thank you, Justin. Geographical wise, I would prefer REITs that focus on Singapore properties. It is easier to understand their fundamentals and performance. You can even visit to these properties in person, to observe the footfall, gauge on the tenant mix and occupancy. You can even see the assets quality and their general upkeep. But seeing the physical property somehow, will give a better insight and convictions on the risk quality and the management execution, rather than purely relying on numbers and data. Likewise, for sectors, I will prefer the healthcare focused REITs. To me, this is sectors which I have a very strong convictions. I do believe that healthcare is kind of evergreen, even in different market conditions. How about the rest? What's your thought on this?
Yeah, Darren, what's your thought on this?
Okay, if we are looking for opportunities in risk, personal view is I personally like industrial REITs. But industrial REIT got many different asset class by itself. So if you are looking at industrial, I would prefer to focus on data center or those industrial REIT that have high tech industrial property, because that's mainly for growth. But if looking at stability, I would like Singapore asset that have shopping malls, that have quality shopping malls. But one thing you need to think, when you invest in REIT, you must always be mindful on the interest rate movement. If now interest rate come down, but doesn't mean that in future you'll not go back up again. And when you want to invest in REITs besides Singapore, you want to invest overseas REITs, then you must look at the geographical risk of the REITs you are investing in, the country you are investing in. That's something you need to consider. Maybe I'll let Charles to elaborate more on that.
Thanks, Darren. I tend to be a bit more technical, and pardon me for being too technical in this webinar itself. Across the board, actually, the risk is actually getting better because of the tides are actually rising because of the interest rate environment has actually come down tremendously. If you look at which I mentioned, the SORA actually has come down to about 1.3. The US side actually is still hovering at that 3 to 4%. There's a great difference because of the demand for Singapore Sing dollar assets itself. I'm looking at our daily job is actually to look at across all the segments itself. But one of the key challenges is actually most of the REITs actually has different geographicals these days. But I think majority still have a very, very big portion of Singapore, but some is actually quite specific, like China, CLCT itself, or BHG itself, or even like those US geographical located assets itself. On the whole, we tend to pay attention to more on these segments, the business segments, which is the office or the hospitality and the healthcare segments. By looking at all this, we are able to identify drivers quite easily. Like for example, across the board, all REITs, we also will look into the demand and supply of the properties coming online this year, next year, or maybe the year after next itself. So if you look at the office segment itself, it has not been doing well, but of course, if you look at the share price across the board, everyone is doing well, except maybe the hospitality is actually lagging a bit this year itself. Office also has been doing quite good in terms of the capital REITs, coming to about 20% year to date itself. But underlying, if you look at the office rental, has been sliding over the past year, and we have seen a slow decline. But the decline is actually slowing down in Q3 2025. If you read into the URA reports, that will give you a very, very clear, better indications. But we also, what we are kind of comfortable is actually on the supply side, the 118,000 square meters of office space will be made available this year, 113,000 next year, and then 46,000 square meter in 2027. So which means the supply is actually coming down, which is good for rental rates itself over the next 2 years. On the tourist hospitality side, last year was great, but this year was not so great, because if you look at the published statistics by the SingStats or even the Singapore Tourism Board, if you track on a month-to-month basis, you can see actually this year the tourist growth is only about on a year-to-date up to maybe September or October itself. The growth rate overall tourist arrivals in Singapore is only up about 2% versus 2024 versus 2023 of about 20%. So actually the increase actually has muted this year itself, also because of the lesser events in Singapore. But if you look at the biggest contributor, which is the Chinese tourist arrivals, the exchange rate also plays a key role in for tourists from China to come to Singapore. So this year, the Sing dollar actually was strengthening against the yen towards the first half of this year by about 5%. But now I think the yen also has climbed back. On the whole, I think as of now is up about 2.5. This if the yen continues to strengthen, which I think we believe the yuan should continue to strengthen over time, given that the economy is getting better. It will encourage the tourists to come back to Singapore better in that sense. On the long-term wise, I think there's not many healthcare REITs that we can look at, the quality ones. There's only one name in Singapore, which is the Parkway Life REITs itself. So this has also been our core allocations in this segment itself, because we believe aging population structural themes, also the recent weakness in Sing dollar will improve medical tourism. Thanks.
Thank you, speakers. Yep, well, there you have it. So these are the sectors and geographies for investors to pay more attention to. I think our speakers shared quite a bit on this one. Yes, let's move on. So our next question. So this was a quite important question. How do factors like interest rates, inflation, or property market trends affect REIT performance? So let's hear from our speakers on how these factors can come into play and what should investors also keep in mind. So I think Charles, would you like to go first this time?
I try to keep it short because I think all this has been more or less covered by my earlier
Yes.
questions itself. But just to recap, looking at the interest rate cycle, Singapore has actually come down. The US is on its way down. Yeah. So for REITs, they borrow both US and Sing. For both currency itself. So with all this interest rate coming down, I think this will also affect the REIT's performance in terms of the DPU, the distributable per units that's being paid to the unit holders. You have a higher payout given by the REITs itself. Of course, this is you have to look at other areas like the business model of the REITs itself. In terms of the retail, you also have to look at other drivers. In retail itself, especially Singapore retails, the past 2 years or 3 years has been very, very resilient, thanks to the government's so-called the vouchers that has been handing out. Especially this year, I think that the voucher is also very, very, very huge in terms of given to the household itself. But moving forward next year, might be a bit of the slowdown in sales, and also the unemployment rates might creep up a bit in that sense. So this also will curb spending on the household itself. Of course, another thing that we have to look at is also the debt maturity profile itself. For REITs who have a larger debt maturity profile this year or next year itself, we'll see a better improvement in lowering the expense charge resulting from in the higher distributable incomes to unit holders itself. Then REITs those REITs will have a higher, who has a higher debt headroom itself, which means the current debt head threshold is actually has also increased to about 50% itself, and those who have a very, very big wide margin from that the threshold itself will actually give them more so-called firing powers to acquire assets from the sponsor, and those with a sponsor REITs itself, they are able to do better than those without a pipeline of assets itself. Yeah.
Thanks, Charles. How about you, Darren? Want to share some a bit on the factors? Yeah.
I think Charles has covered all the key main part of that already, but I just want to summarize that. So do take note that interest rate will have a direct impact on the REIT's price, but now interest rate is coming down, I think, which is good for investor in the near term, but just be mindful of interest rate may rise in future again. And when talk about inflation, of course, high inflation will hurt REITs because if the cost rise faster than the rental, they can increase, then you will affect the REITs. But however, if the property value and rental income increase over time, then actually you will be neutral off and it can be even better for the REITs. And next is the property market trend, where we look at the demand and supply. If there's a demand for office and malls, and that will directly impact the occupancy rate and the rental income, which in turn will affect the REIT's earning and the price. Maybe I'll let Brian to sum up more on that.
Thank you, Darren. Okay, just to add on what the rest have covered. Okay, just make it simple. All this surely will have some form of impact on all these factors. Either directly through fundamental performance or indirectly, example like those investor sentiment, borrowing costs, capital flow, etc. Okay, let me quote you some examples. Like 5 years ago, REITs go through the COVID sell-off, similar to any other shares, where investor sentiment is so fearful. So investor sentiment, can be very important, and all these are directly factored by this interest rate, inflation, and property market trend. And 2-3 years ago, due to high inflation and rising interest rate, REITs again tank. So these are probably examples that you need to take into considerations. Yeah.
Thank you, speakers. So I think it's really interesting to see how these broader economic factors, like interest rates, inflation, property trends, all these factors can actually shape REIT performance very directly and indirectly, as our speakers have mentioned. And from what I'm hearing, I think it really comes down to really understanding the macro environment. We need to stay informed as well, and rather than reacting emotionally to short-term movements, I think that's what is most important. Yeah. Okay, let's move on. So I think we have come to the third and final poll of the night. So I will flash and read the poll again right now. So if you decide to invest in REITs, how would you prefer to do it? This is for our, just now our not sure yet people. So right now we have 1, buying individual REITs directly, and we have 2, through a unit trust or ETF, and 3, not sure yet. You can put in your answers. Okay. Okay, so quite obvious here, we have the highest amount, 68%, buying individual REITs directly. And then number 2, 20% coming with through a unit trust or ETF, and a last small portion saying not sure yet. So which one is, let's find out which one is really better from our next question. Yeah. So which way works better? Should investors consider unit trusts or ETFs or instead of buying individual REITs? Let's hear from our speakers. Yeah. Brian, would you like to go first?
Yes. Yeah, they should. Now unit trust and ETF should be investor core investment. This is an important approach to avoid concentration risk. From their core investment, they can further accumulate individual REITs to enhance their investment portfolio. Now, it is a concern if investor only pick 1 or 2 REITs counter to invest only. Especially when it underperform, the impact can be quite significant. Yeah, how about Darren? What's your advice?
Okay. Buying individual REITs, of course, a lot of people will want to do that as you can outperform the ETF or the unit trust. But unless you got a lot of time and you have time for research on that. But if for those investors who already got no time, which actually most of them is, unit trust and ETF can be a simple, more diversified way for you to invest. Because you spread your money across many REITs, then you reduce your risk of any one property or one manager that performing poorly. And it's also more convenient for you to monitor individual REITs, though you still need to watch out those fees and make sure that the manager's performance and the objective of the REITs match your goal before you make any investment decision. And maybe I'll get Charles to give us his perspective also.
Allow me to share my views on this. So I acknowledge the concept. I mean the polls results. I do believe that as a majority of us still wants to buy individually. I mean some of the risk of buying individually is actually on the. I mean like what Darren has mentioned, like you have to do a lot of much more homework, and then corporate actions also will impact because of the rights issues, and then it also be a hassle for some. I mean, I'll say most of the investors itself to go through the corporate actions side of things itself. But something that I think some of you might not take note is actually as institutional investors like myself, we do get access to those private placements by the REITs on and off on a regular basis. Especially this year, we can see a lot of private placements has been issued out. And in terms of the discount, I would say it's very attractive, but it still gives a good decent discount that we can take advantage of by taking up the private placement. But this private placement is actually not available to the retail investors in that sense, So I would say this is also a so-called a slight advantage that we have over the general investors itself. The role of the fund managers in the performance of the REITs, UT, and ETF itself. I think ETF has become a very popular instrument, whether is it a REITs or a market index across the different geographical itself. It gives, because of its low expense ratio, investors will be able to have a better upside, or say performance over time itself. And in terms of the role of the manager for a UT REIT itself, it's expected the manager should be outperforming the index itself. But a lot of times, outperforming the index is not just the sole focus of the fund itself. Some funds actually do have a design of the distributions of cash flows back to investors itself. So this also will impact the performance of the outperformance of the overall outperformance over time, as compared to those who doesn't have a distributable income that is being given out to investors itself. That's what I'm trying to elaborate, the role of the fund manager. But of course, the role of fund manager is actually to make sure the fund is managed in accordance to what is being stated in the prospectus or the trust deed itself, as to protect the unit holders over the long term itself. Yeah, that's my take. Thank you.
Thank you. Thanks, speakers, for that. So I think to sum up, for most investors, unit trusts or REIT ETFs can actually serve as a core diversified investment. It also helps to reduce concentration risk while still giving exposure to REITs. So from there, investors who wish to explore further, you can selectively add individual REITs based on their preferences and goals. So I think for me, my takeaway from the sharing just now would be that, it's all about finding the right balance between convenience, diversification, and also our own personal investment objectives. Yeah. Okay, let's move on. We're running a bit late. So now let's move on to our next question. So how important is the role of a fund manager in the performance of a REIT, unit trust, or ETF? I think Charles will be the right person to answer this question. Yeah, Charles.
Sorry, but I think just now I overran the questions with my previous question itself. I think just to recap and elaborate on the role of the fund manager itself. It's never been easy. I think for most of the unit holders to expect the fund managers to so-called make money for the investors itself. I mean, this is the baseline, I would say. But the point about making money for the investors is how long do you take to make that performance, or the outperformance, or the money for the investors itself. But a lot of times, not many investors will have that patience to stick with the managers over the long term itself. We have different investors coming in and out. Some taking short-term view, some taking those who is more faithful one, they'll go along with you over the long term itself. So that actually will make the management of the fund much easier. If everyone is going for short term, it will be very challenging for the manager because of the structure of a unit trust. If the when inflows coming in, the managers deploy the money to reduce the cash drag itself. Over the short term, if the money goes out again, the manager will have to sell off the assets, whether they like it or not, to meet their kind of redemption. So this is actually what the role of the fund managers would do. But of course, in terms, they can't control how investors will have a view on your fund, whether it's a short term or long term itself. Which I mentioned earlier, so the fund has its own set of do's and don'ts. And sticking to these do's and don'ts in the prospectus and trust deed itself is also a key role of what the fund manager should abide to itself. Thank you.
Thank you, Charles. How about Darren? Do you want to share a bit on the role of a fund manager?
I agree with Charles that when you invest in unit trust or ETF, you should take a longer time view rather than a short time view. And for unit trust, most of them are actually actively managed. People have the misconception active managed means the fund manager trade in and out, but actually they are not going to do that. But a fund manager also can, in a way that they can add value by selecting quality REITs and managing risk, and then adjust exposures based on market conditions. But for risk ETF, where we have 5 risk ETF actually listed on SGX, but do take note, all these ETF are usually tracking an index, so they are more towards a passive role rather than an active role compared to the unit trust. So the fund manager role is mainly to keep the cost down and ensure that the fund able to follow the index closely. So the performance of that for ETF is mainly more dependent on the underlying REITs that follow the index, and rather than a fund manager stock picking skill. So there's something we need to differentiate between an active and a passive way of the REITs, unit trust, and the ETF. Okay, Justin, maybe back to you for that.
Okay, thank you, Charles and Darren. So I guess understanding the fund manager, yes, thank you. I think understanding the fund manager's role, this can actually help investors make more informed decisions when choosing between active funds and ETFs. Okay, so before we move on to our exciting Q&A section, we welcome you to connect with PhillipCapital or with any of our financial specialists tonight. So Brian, Darren, and Charles. If you would like to know more about tonight's topic or any other questions related to your finance well-being, feel free to reach out to any of our speakers by scanning the QR code here. Yeah, you can, if you have more questions, you still can reach out to them. And I'm sure from tonight, we can see that our speakers, they are very generous in sharing all these value-added tips to their clients and followers. Next one. So for those who are also enjoying the webinar like tonight's one, you like this kind of content and would like to stay connected with us to receive more updates, do give us a like and follow our Facebook and Instagram page. Just have to search Phillip Wealth Advisory. Yes. Okay, next one. So now for the exciting part of the night, let's get on with the Q&A section. So I think we have some questions here. Let me just pull the question, find the question, and then we will get these ongoing. Yeah. Okay, we have a question here from Miss Judy Ong. So thank you for the question. Why is the growth in REITs unit price very slow? For some, it is stagnant. Brian, you want to take this question?
Okay, thank you. To begin with, REITs is not like tech counters, where you have very high growth, very high sales performance, or very good future outlook. It's supposed to be a steady kind of business where the underlying are all properties. You can't expect a property value to skyrocket the next year, next day, just by double fold. That's not just kind of possible. So probably this and also reflected in the share price movement. But of course, it does factor some sentiment kind of movement or fear movement at times. So we can't really expect high growth in this area. But what it really offers is steady, dividends approach. And last but not least, yes, property itself in the REITs do have maybe some form of capital appreciations as times go by. So it really depends on the assets in it as well. So we can't expect too much, like any other high growth counters. Yeah. So I would say that's normal. Yeah.
Sorry, allow me to add on also the REITs, yeah, agreed on the high growth itself. Of course, it's not easy for REITs managers to double their portfolios from 1 billion to 2 billion or even to 3 billion, especially those without the sponsor pipeline itself. If you look back the mid-teens of the 2000s, REITs actually was the price actually was rising quite fast because those days actually we have a lot of acquisitions coming in, and acquisition is actually very positive for pricing, the incremental pricing itself. Of course, it has to be blend in together with the low interest rate environment during those periods itself. And yeah, thanks.
Thank you, Brian and Charles. We have another question by Ko Boon Huang. Can the panelists share their REIT asset allocation recommendation for retirement income purpose? Yeah. Darren, could you answer this question?
Okay, Ken. Thank you, Justin. So when it comes to retirement income, most of the time I'll recommend REITs as part of the asset class for retirement. But I'll usually advocate that it should not be more than a quarter or 25% of your total portfolio. Although REITs pay higher dividend than a lot of asset class, but however, do take note they can be volatile as they can be affected by interest rate cycle, property market cycle. And also another key part of REITs is there is always something called equity fundraising, where they call for right issues. Imagine you are retirees and the REITs call for right issues and they ask you to give them more money. So where are you going to find the money to give it to them? So that is another concern when you want to invest in REITs for retirement purposes. But when you invest in REIT ETF, you will not have this issue at all because the fund manager will take care of all those right issues. So that is my take on how much we allocate a REITs to your portfolio. Okay, back to you, Justin.
Thank you. Okay, we have another question here by Danny Ong. Yes. Okay, we have another question here by Danny Ong. How do managers of captive REITs ensure that sponsors do not divest lower performing assets into the REITs? Charles, I think you can take this question.
How do managers of capital ensure the sponsor do not divest lower performing assets into
Performing asset.
um the sponsors most of the time will have a skin in the game itself. That's the first thing that we maybe invest in REITs itself. We have to make sure the sponsor will have a decent skin in the game, which means they have a stakes in the REITs itself. So whatever they do negatively will impact them over the long term. I mean, to be honest, REITs is also a vehicle for sponsors to offload their assets. But the risk manager will have their own independent mindset as to what to buy from the sponsor, and that is their fiduciary duties to the unit holders of the REITs itself. That's very important. And of course, sometimes depends on situations and the environment itself. The deal might not be so great. Of course, you have to weigh with the size of the deal itself. If it's not going to be very, most of the time it'll be a accretive deal to the existing yield itself. But sometimes it might be lower because of the situation in the market itself. Over time, the sponsor also need to offload the assets to recycle the so-called capital to acquire what is attractive in the market itself. And same goes to the risk manager who will have to decide if the risk manager over the long term they don't act or think on behalf of the unit holders itself. I think you come to the stage that which I think Brian has mentioned, like Sabana, also the unit holders will sack the REITs manager. And then to a certain extent, I mean, to a point of time, they will internalize the whole management of the REITs instead of getting an external REITs managers to manage it. Yep.
Thank you. Thanks, Charles. Okay, we have another question here by M. Xiao. Thanks for the question. As part of an overall investment portfolio, what is a prudent percentage allocation to REITs? Brian, I think you can take this question.
Oh, okay. Well, prudent percentage to REITs. Well,
Yeah, what would you say? Yeah.
as a whole portfolio, if you factor things like fixed income, and a lot of people in the market always say balance, balance, balance. Okay, personally, my risk exposure probably fall between the 20 to 30%. I personally really like the nature of the dividend play plus kind of a capital upside potential. But after all, it still really have an equity nature. So because of that, it's not easy to have a high percentage. Even so, their movement not supposed to be very high, as compared to those foreign counters, etc. So I would say the sweet spot maybe personally I feel 20-30%. Yeah, to begin with, until you're very comfortable. If you want to, you can increase the ratio. Probably assets that you can really go with a higher ratio, things like fixed income, all these, yeah, it's a lot easier. Yeah. But when it comes to REITs, I think at the start, maybe even you want to approach on a 10% first before you consider to increase higher.
Thank you, Brian. Okay,
Justin,
I think we'll take
Justin, sorry,
another
allow
one.
me to add a
Yes.
bit. I may give my
Yeah,
case
sure.
of the view itself. When I look at REITs, in investment itself, I look at the correlations. Because REITs are interest rate sensitive. Banks are also interest rate sensitive itself. A lot of investors also have banks exposure in Singapore as well, especially the three local banks itself. And these two actually don't really correlate to a great extent itself. So maybe if you have a certain level of banks exposure, you can also have a certain level of REITs exposure in some ways itself. So that's my thoughts. Thank you.
Okay, thank you, Charles, yeah, thanks, thank you. Okay, we will take maybe one more question by Eng Wan Lo. So, what are the differences and similarities between REITs, business trusts, and infrastructure trusts? Darren, do you think you can answer this question?
Oh, okay, Ken. Thank you, Justin. This is
Yeah.
what there has a lot of confusion among investors. Okay, because all got the word trust behind them, like Fraser Centerpoint Trust, NetLink Trust. Okay. So do take note that REITs and business trust, they are considered a different asset class, you can call that. For REITs, they can only buy income generating properties. And from there, they collect the rental income and they pay it out as dividends. And they are regulated by MAS. They need to pay out at least 90% of the income as dividends to investor. And they are subjected to regulation, like their gearing cannot be more than 50%. Their interest cover.
Yeah, I think Darren went to a bit of connection issue.
Sorry, I
No
just
worries.
suddenly I get cut off. Okay,
Maybe
maybe
just finish off.
So they are regulated by MS that their gearing cannot be more than 50%, their interest cover ratio cannot be more than 1.5%. So that is some of the restriction MS has imposed on that. But for business trust, what they are mean is they are mainly doing for business. Okay, so they can invest, do in any form of business, like capital infrastructure trust, they are doing on what? The infrastructure, the power plant, the gas pipeline. NetLink, they are doing on the optical cable. So they are not on property, income generating property. So they are not under the REITs regulation, and they are not obligated to pay out 90% of their income as dividend, but most of them will try to pay out as much dividend as possible. And they are not subjected to the gearing and the interest cover ratios imposed by MAS. So they are completely actually different type of asset class on this. So do take note, and also put it the other way out, but we don't really have much business trust in Singapore. Maybe we got only about 7, but we got about 30 over REITs listed in Singapore. Okay, hope that clarified on that question. A misunderstanding by a lot of retail investors.
Thank you. Thanks, Darren, for clarifying for that. Yeah, okay. I think we're getting a bit late, so we won't be able to finish the questions. If you have any more questions, you can always reach out to our 3 speakers over here as well. So let's move on. I think before we wrap things up, right, we just want to get our speakers here to share some final tips with us. So yeah, some final tips for on investing in REITs for our audience. So Darren, would you like to share some of your final tips? Yeah.
Okay, maybe I'll just talk about 5 key things. So when you want to invest in REITs, first thing is focus on REITs that have a very strong sponsor, that have quality asset. Because this type of REITs usually will able to weather a market downturn, and after market come, you're able to become better after market downturn. And number 2 is don't just chase for yield blindly. A lot of investors just see this REIT got very high yield, and they just go in and buy their REITs. You have to check whether is the payout sustainable or not. And the third thing is you must divest across sector. Don't focus everything on retail. Don't focus everything on data center. Make sure you really have a balanced REITs portfolio. And the fourth one is you need to keep an eye on their capital management. Check on their gearing, check on their interest cover ratios. See is the manager taking on excessive debts or excessive risks just to beef up performance in a way. And the last most important is always think long term. REITs are mainly for steady income and compounding your wealth. It is not there for you to make a quick gain out of that. So these are the 5 key things I feel that investors should take note about their REITs. Maybe Charles, you want to add on?
Sure.
Yeah, Charles, what are your final tips for our audience?
I'm actually very old school. I think invest in things that you understand. That's very basic. Whether is it how simple it is, there's always a drivers that you have to understand over time itself. And also, of course, I also understand how operating costs are managed in REITs itself. So this also will give you a so-called a advantage. When some of the managers, they do not do well, and that will differentiate the better ones from, I'm sorry, the better ones from the lousier ones as well. Also make the efforts to attend AGMs. I think from AGMs, if you are a unit holders, you should be able to attend AGMs, and you can hear how management team talks about the business. I guess the turnover, some of the management team, the turnover is actually not very long term. This also will give you a better sense of how these people actually are managing the REIT itself. And the last but not least, follow the interest rate cycle itself. Yeah, thanks.
Thank you, Charles. Okay, lastly, Brian, your final tips for the audience.
Okay, maybe to those investors who probably just thinking to start risk investment or have a very low ratio on their portfolio on REITs, I would highly recommend just stick to ETF or unit trust for your risk investment. It really helps to remove the concentration risk, right? And where this makes investment a lot easier. There are so many parameters to be considered in a checklist to do REIT speaking, and that's not easy. Things like price to NAV, their yield spread, their gearing ratio, interest coverage ratio, their occupancy rate, rent reversion trend, and many, many more. So those are really hard works. Yeah, but if you really still want to consider stock picking, okay, personally, I would suggest to focus on the DPU track record. or simple understanding the dividend track record. It is a very challenging to have a consistent dividend track record over maybe 5 years or 10 years. Especially so when their dividends only come from their earning. It need a lot of good parameter to achieve that. Yeah.
Thank you, Brian. Thank you, Darren and Charles also. I think we've heard a few of the things that you guys mentioned, focusing on strong sponsors, sustainable yields, diversification. We heard this a lot tonight, and also long-term thinking. Yes, and also Brian also highly recommends just sticking to ETF and unit trust for your REIT investments. And I'm sure these final tips that our speakers just shared will actually help our audience approach REITs investing a lot more confidently as well. Yeah, that's great. Okay, so I think we have now covered are REITs still a smart investment now? So I hope that everyone here from our audience, have benefited from tonight's webinar, and we'll also have some ideas on how to evaluate REITs more effectively and incorporate them into your long-term investment strategy. So once again, I can see that you guys might have more questions. Once again, you may connect with any of our speakers tonight if you wish to understand more or anything else aside from REITs, also from any financial related matters. You can also reach out to them. And we have come to the end of tonight's session. So I would like to thank our 3 expert speakers here, for their unreserved and open sharing. And also a big thank you to everyone who has stayed with us through this webinar thus far. So do join us for our future Ask Me Anything webinars as well. And we would love to have you here again. Yeah. So this is Justin signing off. So see you and good night.
Thank you. Good night.
Good night,
Good night, everyone.
everybody.